Welcome to Vision Academy. In this lecture, I will address Introduction to Futures Contract. Along with that, I will also address origin of futures contract and example for this futures contract. And in the series of lecturing this first series, and in the further series, I will address settlement of futures contract, mechanism of futures contract, characteristics, advantages, disadvantages, and so many things. Please stay tuned for further and regular videos. Unlike forward contracts, futures are standardized contract traded on exchanges through a clearing house and avoids counterparty risk through margin money and much more. Most of the problems that are arriving in the forward contract is resolved in futures contract. So in this futures contract, risk is less and there is no counterparty risk and so many things, and everything is standardized. So you are really most of the time gainer in futures contract. A future contract is a standardized agreement. The standardized agreement and it's a legally binding agreement between the seller and the buyer. So seller and the buyer, which usually takes place in the futures exchange. The purpose of that agreement it should be buy or sell certain underlying instrument, certain underlying asset at certain futures date at pre-specified price. To differentiate between forwards and futures contract, forwards contract won't trade in standardized exchange. It trades in OTC, so it means it's a private contract. Other than that every feature of forward contracts remains same, so that there must be two person, one is short position, one more is long position, and the intention is to buy or sell a certain underlying instrument at certain date and at some pre-specified price, so and so many things, but it trades on futures exchange. As we know that future date is called the final settlement date, or else the delivery date on which you are going to get a delivery or expiration date, and this preset price is called futures price. That preset price you are agreed, buyer and seller is agreed for a particular price, that is a futures price. And the price of underlying asset on the delivery date is called settlement price. These things are very essential, you must keep in your mind. So let us know the obligation of the contracting parties. It means there will be only seller and buyer, two party will be there. Let us look into the obligation of both party. It is due to standardized contract, obligation fulfillment is necessary. It means the seller is obliged to deliver a specified assets on which he has taken contract. Maybe it may be securities, commodity, or foreign exchange, whatever, to the buyer on the specified date in the future. It means the seller have to deliver the physical asset or whatever to the buyer on future date, and buyer is obligated to pay to the seller in kind of cash at the price prevailing in the future price upon the delivery date. So it means seller will deliver the physical assets or security, commodity, or foreign exchange, whatever, and buyer will give money or in kind in return to that commodity, security, or foreign exchange. So this the pricing can be based on the open outcry system. So it means earlier in BSE it was happening under a floor, the demand and supply, based on demand and supply, price was fixing. That is a open outcry system or bidding, and now offers can be matched electronically. What is happening in the exchange is now it is matching electronically. The demand and supply is matching electronically, and the price will be fixed electronically. If you want to know the origin of futures contract, where it is emerged and so on, Truly it is originated in Japan during 18th century and was primarily used for trading rice and silk. On rice and silk futures contracts were taking place. And 1850 onwards, the USA started using futures market to buy and sell commodity. So after 1850, USA also started to buy and sell using futures contracts, such as mainly then the main commodity was taking place. The contract is cotton, corn and wheat. And now if you look into the futures market globally, it's a global market for not only agricultural goods such as cotton, corn, wheat and so many things, but also for currencies and financial instruments such as treasury bonds, security, most of the securities, and maybe bullion market and foreign exchange market. On many more markets have depended on the futures contract. So it's a global marketplace now. Global marketplace, it has a wide range of investor and the broker and many exchanges it has, and so many things. So in the futures contract, it's a diverse meeting place for farmer, exporter mainly using for foreign currency, importer exporter are using foreign currency, manufacturer for their regular supply of raw material, and speculator to gain more profit in the stock market, and so many things. It is a meeting place for these people. As we see, future market is a wonderful place compared to any other market, example forward market and cash market, any other market. Future market gives a very wonderful advantage to the investor. Let us see how it works in this case. So it's a trading in futures versus cash market. So you can compare futures trading and cash trading only through cash. So example, that company X desired position is 1000 shares. Company wants to purchase of 1000 shares. So for that it will use futures market as well as cash market. Okay, so then it is, this side is a futures market and this side is a cash market. So current stock price at now is 200 rupees. It remains same for futures and cash market. So 200 rupees for future market also, 200 rupees for cash market also, and required margin is 11% in case of futures contract, and it is not applicable to the cash market. Okay, so here if you are going to buy 1000 shares on the 200 rupees per share, if the current price is, it means 2 lakh, your total value will be 2 lakh, that is 200 into 1000, 2 lakh rupees. The value of purchase under cash market is 2 lakh rupees, and so you have to pay 11% margin in case of futures market. So then if you calculate margin money available, so that 200 into 1000 share, that is 2 lakh, and over 2 lakh, 11%, 22,000. So 11% by 2 lakh into 100, it's a 22%. Here also in the futures market also, the total value you are purchased is 2 lakh. So additionally you are running through margin in case of futures market. Here you are running through only cash in case of cash market. Okay, then total money required to take position of 1000 shares would be, in case of futures contract, only 22,000, because you are running through margin. You paid 11% margin over the value of 2 lakh, that is 200 into 1000. Okay, now it means you only invest, the total money required to take position in futures market is 22,000, but in case of cash market it is 2 lakh. Understand, it is 2 lakh, because you are directly going to buy the particular you are going to take directly that position. So no regulation, no standardization, and no margin also. So directly you have to invest 2 lakh rupees in case of cash market. Okay, so now let us know, if the stock price goes by 10%, so 10% up, if it went to 10% up, let us know how it will implicate on futures market and cash market. So profit in future market is to 20,000 because the value of money purchased is 2 lakh. 2 lakh over 10% over 2 lakh is 20,000. Okay, here also same, the value of purchase is 2 lakh, 10% over 2 lakh is 20,000. Okay, but the gain on amount invested, let us calculate the gain. So you invested how much? That you earned 20,000 into 100 divided by 22,000. This is 22,000 is investment, that is earning is 20,000. 20,000 into 100 divided by 22,000, totally 92% gain on the amount you invested in case of futures market. Whereas in the cash market, you earned 20,000 and you invested actually 2 lakh. 20,000 divided into 100 divided by 2 lakh, it means you earned only 10%. If the stock price goes to 10%, the effect to your security, your position is only 10% in case of cash market. Whereas if the stock price goes by 10% in the case of futures market, it affects 92% gain on your investment. Such a beauty, you know. So that is why it acquired all over the world, in all the market, in all the sector segment and so on, just because you are going to maintain margin. You are running through margin, you are running on margin. So in this case you have given margin of 11% over 2 lakh, it means 22,000 your investment, whereas your gain is 20,000. So it means 92% gain on your investment. Now compare in which market you want to trade, whether cash market or future market. I hope future market is proved a wonderful fact and a record that you earned just by investing 22,000. You earned 20,000. That's the beauty of this. Thank you so much for watching this video. If you are not yet subscribed to my Vision Academy YouTube channel, please do subscribe. Thank you.